Moody's Investor Service has downgraded the entire U.S. banking system to a negative outlook from stable, citing a rapidly deteriorating operating environment. It added that banks with unrealized losses are under particular pressure. Well, joining us now with the latest is Yahoo Finance's Julie Hyman. Hey, Julie.
I mean, I guess on that last point, tell me something I don't know. We've all come to realize over the last few days, unrealized losses on certain bank balance sheets, once they are forced to realize those losses, become a problem. So just to talk about what exactly is happening here, Moody's coming out with this note late last night, but it was only just released publicly in the last hour or so. The headline on this note, outlook change to negative on rapidly deteriorating operating environment. And the Moody's analysts behind this saying that they made this call on the U.S. banking system, that there are concerns here, even despite the actions that the federal government took over the weekend to try to shore up the banking system. They write, while the Federal Reserve's new bank term funding program is constructive, we expect depositor and investor focus will turn to banks that may have a similar mismatch between deposits and asset duration, as well as weaker profitability and capital. We expect pressures to persist and be exacerbated by ongoing monetary policy tightening, with interest rates likely to remain higher for longer until inflation returns to within the Fed's target range. So this is not necessarily a problem that is now done. Bank stocks, by the way, have been rallying today. We learned late yesterday that Moody's was downgrading 6 individual regional banks. We didn't know yet about this bigger call on the banking system more holistically, if you will. We've got bank stocks that are actually rallying today, even in the face of us finding out about this call. That could be because many of them have fallen so much already, particularly if you look at the regional bank sector. Basically, what Moody's is saying is if you look at certain banks and the way that they have managed their assets, what they call asset liability management, at some banks they're faulty, and the interest rate increase cycle has made it more difficult, Rochelle, to manage through this particular time.
So, Julie, break down what a credit rating is and what happens when you do have one.
So you're looking here at not a specific credit rating. It's more of a sector outlook when we're looking at this particular case. So let's talk about credit ratings for individual companies and their debt first, because this is a call on the bonds or the credit of a company, their debt effectively. And basically what Moody's and S&P and Fitch try to do is measure the likelihood that they'll be able to repay those debts. So when you're talking about a company being downgraded, their credit being downgraded, it's just a little less likely that it will be able to repay those debts. Now, it's really on a spectrum of a system here. Why does it matter? Well, if you're a debt investor, it helps you game out what the risk profile is of a given company's debt. Again, this is not a credit rating downgrade per se because it's on a sector. It's more the outlook. So when they're talking about this banking system outlook, it reflects Moody's views of the credit fundamentals of the sector, the whole banking sector, over the next 12 to 18 months. So we're sort of talking about two separate but related things here, Rochelle. On the one hand, the credit rating for the individual banks, which Moody's made the call on yesterday, and now on the entire banking system.
It's certainly important to make that distinction. Our very own Julie Hyman, thank you so much. All right, let's give you a look ahead at what to